Hello everyone and welcome to this week's True Potential Do More With Your Money podcast. Before we get into it, if you've not done so already, please do remember to subscribe to the True Potential YouTube channel. It's quick, free and easy to do so, and will give you alerts for new content coming out from the team. So somewhere along the bottom of your screen, you'll have a bell icon, you press that, and it is as simple as that. So today is Friday the 12th of March. It's episode 59 of the True Potential podcast series. And today's session is all about questions and answers. So I'd like to thank our clients for sending their questions in advance. This allows people like me and Jamie to work out the answers in advance and then share them with you today. But more importantly, it's to talk about what's topical, what's going on in the world for our clients. So today I'm joined by what I would call an expert panel. We do have our very own Piers Morgan, Mr. Jamie Sexton, who's head of operations for True Potential Wealth Management. Hopefully he doesn't storm out on us today and stays on the panel. We have the nation's favourite female Geordie. It's not Cheryl Cole, it's Rebecca Wright, who heads up our customer care team. And then we have Mr. Nasty, the main man. It's not Mr. Simon Cowell, it's George Bell, who is our investment analyst, or as I would call him, an investment expert. So welcome everybody. How are we all doing today?
Well, not very good now, Greg, considering you compared us to Piers Morgan. I don't know if that's the lockdown pounds, or you think I look like him, but I nearly stormed off after that moment, but so I'm pretty good, thanks.
Good. Rebecca, how are you?
I'm well, all the better after I got the nicest of the free introductions there, so feeling good.
Yeah. And I think, George, you just got Simon Cowell because you're always well dressed. That's why you've got your shirt and your jacket on today. So
you can't see, but I've got my trousers pulled up to here as well. So
good. Yeah, that's a little secret for the viewers, isn't it, today? So George, good that everybody's well, and thank you for joining. Thank you for taking your time to help me out with some of these questions. And Jamie, before we kind of move on to the normal podcast sort of questions and answers, it's been a busy week for True Potential. We've featured in the news quite a bit. Do you just want to do a quick roundup of some of the things going on?
Yeah, a couple of good things that came out for us. Really exciting from a new business perspective. We had the largest inflows in Q4 2020 for platform sales, which I think is a fantastic achievement for ourselves and for our clients. And that's basically encouraging people to effectively invest and trust their money with us, which we're very, very proud of. And then a week of awards for us as well, Greg. And I think what's quite good about these awards is that, where our peers and our advisors do vote for them. It's the City of London Wealth Management Awards. So we got Best Fund Platform, and we were highly commended in the Best Mobile App, which I think we should probably talk about that a little bit later on. And Best Newsletter as well, which is some of the comms, or a testament. I think that's one of our first awards for the sort of the marketing side of things, which is fantastic in terms of the content that we produce for our clients. So yeah, really proud of them, and we'll add them to the many that we've won over the sort of last 15 years.
Yeah, thanks, Jamie. Hopefully this podcast today doesn't take it all downhill, and we keep the content good and we keep the votes coming in. So thanks for the update. And it does seem to be awards season, which is a shame we're in lockdown, because you normally get to put your dress. I mean, you get to put your tux on and you get to go to all of these award ceremonies and get a couple of free drinks and the like along the way. So it's a shame that we're having to dial in for these events, but nevertheless, True Potential still collecting awards, which some things don't change. So in kind of typical podcast fashion, George, if you're okay, just giving us probably an update on the markets and also just some of the key themes that you're hearing at the moment, please.
Yeah, sure. Some important updates which have came out this week. This week we've been sitting down with all of our investment manager partners as well. So we've really been challenging them on their views, but really getting under the bonnet of what's going on in the markets. So in terms of the events which you've seen at headline level, Wednesday was a key event. You had the approval from Congress, although it was a very narrow approval. You had a vote of around 220 to 211, i.e. the Republicans voting against the package almost entirely. But this was for President Biden's $1.9 trillion fiscal support package, or more specifically, a coronavirus relief package. So remember, we discussed the $900 billion package, which was enacted at the beginning of last year, started to roll into effect at the beginning of this year. Effectively, this is an additional stimulus package into the economy. So I say anticipated because it wasn't a surprise. It's been an ongoing wrestle since Biden came into his first term of presidency. The package was very much top of that list of items on the 100-day plan. But in terms of where that money is actually going to go, you've got around 37% of the budget which will go directly to households, which is on a means-tested basis, but those could be eligible to around checks for around $1,400 effectively, which will have a positive spending impulse. 36% will go to local governments and states for investments. You'll have around 20% which will go to unemployment benefits. So you can see top-ups there up to $300 a week, which is a significant amount, on a monthly basis. The remaining 7-8%, I'll just do the maths there, but that will go to support to smaller business there. So you've got a number of items there which will have an immediate fiscal impulse on the economy, and the markets responded very positively to that news, that package actually getting pushed through. So that will be on Biden's desk for signature there today. Now, whilst this gives an indication of the reaction of the post-event, there's been a lot of focus on the implication of the additional fiscal stimulus package at a time when actually the economy is starting to open up. We've seen vaccination rates are ticking up. We've seen the program has been accelerated over the last week. If we look at vaccination as a proportion, we know Israel has really been the playbook there, really leading the way. The UK has vaccinated around 35% of the population. I'm sure we all know people now who are on their second round of vaccination in the more elderly population. But the US has really accelerated over the week. It's gone from around 24% up to around 29%. So we know from the evidence with that, we're seeing improvements in activity level. What we're looking at there is things like mobility data, which is coming through, but also labour data. Yesterday's jobless claims showed that claims were at their lowest level since November. So since we had this real second surge of cases coming through globally. But we've still got around 712,000 Americans making initial claims on a weekly basis. So although that level is coming down, it's improving, it's still elevated. It's about 500,000 higher on a weekly basis than where we were pre-pandemic level. So yes, the economy is starting to recover. We're seeing activity levels picking up. This stimulus package, however, for many expectations was required in order to provide that boost and carry us through until the stages where the economy can open back up fully. The second point which came out was really the OECD report. So the OECD is the Organization for Economic Cooperation and Development. They set out expectations around economic growth and inflation. It was a positive report. We'll just put that out there. The OECD essentially went back to the estimates which they set out at the back end of last year in December and revised them higher. So what they're saying there is global economic growth this year is expected to be 1.4% higher than what they expected. So globally, economic growth for 2021 expected to be about 5.6%. Essentially, they're putting that down to two main factors. One being that impulse of fiscal stimulus within the US, not only having a positive effect on the US, it's expected to add around half of the 6.5% of growth which is coming through in the US this year, but it will also have a spillover effect as well, Greg. So it will spill over into the key trading partners which America deal with. So Canada, Mexico, and Europe as well, because of that additional spending which is coming through. The second point which the OECD noted as a point for revising those expectations was really healthcare management and vaccination. And I've just gave some examples and statistics there as to where we are with that program overall. Now, the growth is positive, but what investors have really been focusing on is inflation. And we may jump back into this with one of the questions a little bit later on, Greg, but I think the expectation of inflation really explains a lot of the movements which we saw in the bond market, particularly last month. We had yields on 10-year government bonds in the UK move out from 0.32 to 0.82 in the space of a month, which is a significant movement. But why is this happening? Well, you've got a few factors. One being the simple fact that lower yields are less attractive when you've got inflation picking up. So arguably, people are looking elsewhere for returns. That's why you saw better returns within, say, the equity markets. You saw better returns within the high yield market. So brings out again that message of diversification of assets, but one of the more powerful being because the market is beginning to test central banks to suggest interest rates should perhaps be higher where they currently are, given the strong growth which we're seeing coming through and the expectation of inflation to follow that. Now, central bank and a number of our managers this week recognise that, yes, we'll see a base effect this year. That's just a function of the maths in terms of how that year-on-year calculation is formed. If we think this time last year, when the world was very much at the beginning, or the wider world outside of East Asia was very much in the earlier stages of the COVID outbreak, you had oil prices, oil futures contracts trading on a negative basis. If you think about where we are now, the jaws are wider in terms of that inflation gap, so the number appears higher. So that's why you've seen a bit of this reaction. Central bankers, so referring to, say, the Bank of England and the MPC in the UK, the US, the Federal Reserve, in the comments which Jay Powell, the chairman there, has been making, is really that they're not anticipating inflation to be uncontrollable. They're not anticipating it to be out of hand. They are happy to let it overshoot on a temporary basis, given the technicalities which you've got in the marketplace there, given those base effects and so on. But they're really pointing towards areas such as the benefit of technology, which is reducing input costs. You've seen the benefit of, or you've seen not the benefit, but the fact that you've got unemployment levels elevated is perhaps reducing the pressure which you have on wage growth inflation. So there's a number of factors which are really referring to the fact that, yes, we're recovering, but there's still some slack in the economy which will prevent the impact of inflation coming through in that sense. That was echoed yesterday by the ECB. The ECB came out yesterday. We were not anticipating a wholesale shift in their approach. They acknowledged the same sort of approach around inflation. They kept interest rates at their current rate. They kept their bond purchase program at the same level, about 1.85 trillion euros, but they will pick up the pace in which they're buying bonds from the market to help bring those yields down overall. So quite a jam-packed week, a lot of focus around what's been happening around growth, inflation, and the comments which we've had on the back there from central bankers and from the inflation reports from the US in particular. So far this week, you've got global equities up around 3.5%. Got FTSE 100 up around 1.5%, US stronger, up around 4.5%. Bond markets a little bit calmer this week, sovereign bond yields as you start to see them drift in a little bit at the margin, higher yield and debt broadly flat on the week there. So bit of a calmer week in terms of the bond markets compared to what we had in February, but bit of context there, Greg, which has been coming out this week to explain some of those moves which we're seeing.
Great, thanks, George, and I think as kind of insightful as ever and bringing all of our viewers up to date with the week that was. So that probably gives us a good opportunity now to move on to the questions. So at this time of year, we obviously are approaching tax year end, or as I like to call it, tax year start, because a new tax year also starts at the same time as one finishing. So what I'd probably point out to anybody listening today is that tax year end falls quite awkwardly this year over a bank holiday weekend. So we have the kind of Easter break. So do, if you have left it late, and it's not too late just now, get in touch with our customer care team or your financial advisor to make sure that you've got your ducks in a row, I would say. So and we're going to cover that off in some of the questions. So Jamie, probably the first question, and I think this one's most relevant to you. I know you've been given a fair amount of advice recently to clients and helping them, make sure that they don't lose any allowances. So if we just kick on to the question, so what is the importance of tax year end, which I think is obviously the first and main part of the question. But then this client's gone on to ask, what should I be thinking about in relation to it, and also my money? So if you can just kind of take that one away, Jamie, and just explain what is this thing we call tax year end?
Yeah, so basically in terms of tax advantages that are given by the government, they run from a period of 6th of April 1 year to 5th of April the next year. And it's really important that when you're looking at your sort of savings, and when I advise a client looking at the savings, is we look at the most tax efficient place to put that money to start off with. And typically that's an ISA. So every year you'll be able to save £20,000 into an ISA, and effectively that is tax-free growth. And we send communications out about this quite often, but it's like once opportunity where you will you lose it. So you will lose that £20,000 of allowance, and it renews every single year. So it's quite vital that if you've got the opportunity and you want to complete that, get that in there now. The other thing I would say is there was a slight change to the way the ISAs worked a few years back, which has allowed what we call flexible ISAs. So where if you've taken money out within the tax year, as long as you put it back in within that tax year, you don't lose your allowance. Which is, when I've looked at a couple of clients recently where we've kind of topped up nearly £30,000 into their ISA, and they hadn't realised they needed £10,000 to do some work to the house, and hadn't realised they could actually take advantage of the full amount. So it's worth it's definitely worth looking at that from an allowance point of view. So for ISAs, £20,000. For the parents amongst us, our favourite junior ISA, you can put up to £9,000 into a junior ISA every year. Obviously, the rules around junior ISA are slightly different. You're investing for your children, they can access that when they're 18. But once again, it's another great way of sort of using tax-free sort of growth efficient savings. There is obviously allowances for pensions, and that really does depend on your circumstances of what you can contribute. Typically, it's up to £40,000 or whatever your sort of income is. But that can change based on your circumstances, based on your contributions from the previous year. So you can backdate up to 3 years as well. So it's worth, if you're thinking about, especially as a business owner, if you're thinking about putting in some one-off contributions, get that done ASAP. It's vital that you get that before tax year end. But we can help you as well. So if you want to understand, speak to a financial advisor, if you want to understand exactly how much you can put in, it's quite an easy sort of calculation. I think these are great savings in vehicles. These are things that the government have put in place to encourage us to save. And it's kind of use them or lose them, as they say.
Yes, exactly, Jamie. And I think just taking that one a wee bit further, you mentioned at the start of the session our award-winning technology and giving clients instant access. Every client's got one of these. They can log in to their secure site and access how much of their unused allowance they've got, and using the True Potential impulseSave can top up the difference. So always go to your client website first, log in, check the allowance. It won't allow you to oversubscribe. That's the main thing, is we'll keep you within the goalposts of your allowances, and top up the difference. So that runs right the way through to the 5th of April. So we're not wanting checks sent through the post. We have all of the technology at clients' fingertips.
Greg, I would just add to that as well. When it comes to looking at saving as well, if you can do it more regular, so if you can think about treating it as a bill or a direct debit, that can also help. So when you're starting your sort of savings journey, maybe from the 6th of April, have a think about, rather than say, well, I'll put £20,000 in a year, or I'll put £5,000 in at the end of the tax year. You can put it in regular, and regular you benefit from things that we've talked about in the past, which is pound cost averaging, where you potentially buying units at lower points during the year. But actually, for me personally, because this is what I do, it just makes life easier. It feels like you, I suppose, a bill or a mortgage, but you're benefiting from the savings at the end. So please do think about sort of regular savings, setting up a direct debit to pay into your ISA or your pension. And that's easily done by the website as well, which I'm sure Rebecca can give us a bit of information on that.
Yeah, I think so, Jamie. I mean, that probably segues us really nicely into the next question, which is how can I get the new tax year off to a positive start? And Rebecca, if you want to obviously come in and explain, what clients can do to really kickstart from April onwards into the new tax year.
Yeah, absolutely. So I think you're right. We talk a lot about tax year end, and there isn't a lot of tax year start conversations. You don't have to leave it until the last minute. We've touched on the technology. If you do want to go in, either making one-off contributions, you can use impulseSave, as Greg's as Greg's mentioned there, it is going to keep you right with your allowances as well. So it's not going to allow you to pay over when you're using the impulseSave feature. And you can do that just at the touch of a button through your smartphone or logging into your client sites. If you'd prefer to set up a direct debit, you can go in and you can do that via your client side technology as well. So really straightforward to go in and pop in your bank details, and then we'll start taking that regular contribution for you. A nice way to do it, because it means you can sit back and forget about it. You don't have the rush at the end of tax year end thinking I best get those allowances used up. It's looking after itself throughout the course of the year. So it is really a great route to do it.
Yeah, absolutely, Rebecca. And I think keeping the mic on yourself, the next follow-up question to that, which is, I think Jamie's gave us a helping start with it, but what's my ISA allowance and how do I make the most of it? So that was a question that's come in from one of our clients who's maybe just after a bit of a general update. What is the allowance, but also how do I make the most of it? And I think we've covered some of that off, but worth just digging into a little deeper.
Yeah, so ISA allowance, as Jamie said, it's £20,000. If you are taking money out throughout the course of the year, if you've got a flexible ISA, you can put that money back in as well. So it's 20,000 plus whatever you've withdrawn throughout the course of that particular tax year. The main thing to make sure you're making the most of it is bearing in mind that you do lose it if you don't use it up. So if you are in a position to utilise that full allowance, you really should be doing so. Otherwise, come the new tax year, you have lost out on that benefit. So that's the main thing I would say to bear in mind, is that it's a use it or lose it approach with your ISA.
Yeah, I think that's going to become like a hashtag now, isn't it? Because it's been a couple of times. I think that's the one thing our clients will leave today remembering is I must use it or I will lose it. So thanks, Rebecca. And Jamie, a question for yourself, and I think it's again kind of linked to the topic, but again, this is something I know you and I speak about a lot, and it's one of the things you talk to a lot of clients about. So I'm sure many on the line will be asking the same question. What should I do with cash that's currently invested in a low interest account whilst making sure it's accessible?
Yeah, I think when you're looking at it's probably worth, I always say this as part of every sort of podcast I've been on. It's really about understanding what your goal and objective is with that cash or that money. So what really do you want to achieve from that? So if you're looking to, in 6 months' time, I don't know, do up the house, buy a new boiler, put the kitchen in, then leave it in cash because you're going to spend it quickly. If there's no objective for it and you're actually looking to put it away for a long-term savings, whether that's paying for university fees or even retirement, then you're really not getting the benefit of any growth from a sort of cash environment. I was just looking at the cash ISAs this morning, which, you know, I really don't understand why they're in place anymore. But you're looking at an interest rate of 0.4%. Incredibly low interest rates on cash ISAs now. Where it kind of sometimes makes them pointless. You probably get better interest in actual bank accounts in certain cases. So what I would say is set your goals, set your objective. If you're looking for a sort of more longer term objective, you should consider sort of stocks and shares, ISAs, or an investment vehicle which can make your money grow. Because you've got to think about it in terms of the price of bread today in a year's time will not be the same price. It'll probably be slightly more. And that's the same with your money. So if you leave your money in cash and it's not working for you, then it will erode over a period of time. So it's key. What sort of two top tips there would be: look at your objective. Do you need this money long term? And make sure you set yourself a sort of emergency fund. We say three months worth of sort of outgoings as a cash emergency fund. And then if this is a long term reason, and then please just look to save that into stocks and shares savings. It is accessible, so if I understand things can change. So if you're looking for a more accessible vehicle, look at a sort of stocks and shares ISA rather than a pension which you can't access till you're 55. So it really depends on your objective. I would always say if you're not investing for 2 years plus, even maybe it's a bit more, then you should leave it in cash because there's an immediate need for it. But if there's not, and you look for and you've got a goal and objective, it really isn't working for you where it's sitting at the minute.
Yeah, absolutely, Jamie. I think it's a bit of a, obviously funds are accessible via True Potential. It's not locked in for 10, 20, 50 years. You know, it's subject to the product, which is always interesting. But you're right, it's what's the need of the money, what's the goal of the money before you invest it, and then once it's in, we'll almost do the rest. So it's not locked in as in you can't access it, but it's certainly not something we'd recommend to be there as a rainy day fund to, go on holiday once lockdowns are lifted. It's obviously a bit more longer term than that. And George, just on kind of the same topic, please, just obviously the liquidity of true potential portfolios, it might be worth just a quick mention on that in the way that we run the portfolios so that money is accessible and tradable.
Yeah, sure. I mean, I'll give you two examples, the sort of products which we buy and then also how we oversee it, which might be helpful in reassuring. So the structure of the portfolios means that we can't invest in illiquid assets. So, for example, direct bricks and mortar property is one example. Everything which we buy is on exchange in effect. So you've got that liquidity whereby you can enter, you can exit products on a quick basis. In terms of how we actually oversee that, well, you've got various different things, from a regulatory perspective, a requirement to run liquidity tests, stress tests, that's seeing how quickly you can actually redeem your assets in different environments, different pressured environments, and they'll go back to different scenarios which have happened over time. So like the 2008 global financial crisis as an example, how quickly could you actually get your money back out if that was the case? Now, what we've got in-house is actually an enhanced level of governance. So that's a unit which actually sits within the department who run liquidity and stress tests on a more frequent basis than is required from that perspective. So what that means is if we think about an environment like 2020, where there's a lot of focus on markets and market risk, what we were also observing very closely was liquidity risk. So we knew the type of environment which we were trading in for our clients. So it's an absolutely paramount area to be aware of. That's how we tackle it. We tackle it by investing in liquid instruments, but not being complacent, keeping a regular eye on that. And that's why when we talk about enhanced oversight, enhanced governance, that's where the importance of that comes in. It's not always when the markets are running great. It's in the more challenging times where you really feel the benefit of that added support.
Yeah, thanks, George. I know that'll give a lot of listeners a lot of reassurance the way that we do oversee the portfolios to make sure that it is, as you said, liquid, which just means accessible, I guess, for people like me. That's an easier word to use. So
accessible at a fair price. You can get out of the market at a fair price.
Yeah, exactly, George. Thank you. And keeping with yourself, George, you've obviously had another busy week as well. Speaking to our fund managers, it's something yourself and the investment team do regularly. I guess one of our questions coming from a viewer, they must be a regular viewer, knowing that you speak frequent with the managers, and they're asking what are the key points coming out of the discussions you've had with the various investment partners.
Yeah, sure. I mean, a lot of the points are, which I mentioned in the introduction, were the sort of things which we were thrashing out. But maybe if I just summarize a few examples, I think one is really just recognizing the backstop of support which you've got, or that ongoing support, I should really say, from governments in terms of the fiscal stimulus which they're providing. Here in the UK, you're seeing that in Europe, but more effectively in the US, or to a greater extent in the US this week, but also central banks and their ongoing support to provide that liquidity to the market. So when we're talking about liquidity, what they're really doing is operating within the bond markets, to buying bonds to make sure that market is operating efficiently. They do buy into the economic recovery, which we are seeing, and they're making reference to the official expectations. I mentioned at the beginning there, the OECD report, which was positive, but also the information which they access. So they've got various different models which really dig into, say, mobility data, higher frequency data. So what's been great over the last year in particular, even longer, sort of 14, 15 months, is having access to fund managers and their research departments who are based on the ground in these different locations. So if we think about last year, what was really interesting was having access to that direct team on the ground in mainland China, and they could tell us the sort of activity data which they were seeing, first to give us an indication of the impact of lockdown, but also as we come out of lockdown and you've got East Asia who are operating on a higher activity level, how that's evolving over time, but also how developed markets are starting to accelerate as the vaccine program rolls out. So they are recognizing that, but also putting their money where their mouth is on that. Some of the managers, we discuss how our managers work in slightly different ways. They have slightly different views to one another. That's the whole purpose of the diversified product. But some of these managers who are more selective have been allocating towards those areas which will benefit as the economy continues to open up. Some of this is on an individual company basis. Some of this is more on a regional basis. So what's important there, however, is this is not going to happen at an even rate. And what I mean by that is we often talk about, say, the FTSE 100 or the S&P 500 and the strong returns which you've seen there since March 2020, or even that acceleration up from November 2020 when you had that first Pfizer Monday when that was officially signed off. But what's going on under the bonnet's really interesting. It's not just the headline level. As economies open at different paces, as sectors open up at different paces, you're seeing dispersion. So the benefit of an active manager, and this is why we stress the importance of active managers, is they can actually get in under the bonnet and they can exploit that divergence which you see. And so that's another example which we're seeing through. And just in terms of sovereign bond markets, I mentioned the moves. A lot of the managers recognize that some of these moves are justified. They're justified on the basis of where growth dynamics have got to. But again, their active nature means that they're not tied to one area of the bond market. They can be quite nuanced in terms of their ability to move both up and down the credit rating scale. So I mentioned the opportunities which were present in November in higher yield and debt when you had inflationary concerns come through. You've got the ability to access that. But you're also seeing that dispersion in terms of the extent to the movements you were seeing in government bond markets. So they're able to actually play those off relative to one another. So what it's really demonstrating is, yes, we've been through all of these challenges, but what our managers are seeing at this stage is opportunity. And our job as the investment team is to oversee how they're actually exploiting this opportunity for clients, how that's performing, and where we go from here. So that's really what we've been mapping out over the week. So another fascinating round of calls. We have regular contact with the managers, but we also have this formal meeting in the diary with the managers once a month where they do bring on their wider research teams as well. So it's a fantastic week, which will lead into a deeper discussion on the portfolios, which I'll jump onto straight after this session.
Yeah, great, thanks, George. And again, kind of very, very insightful with regards to what's going on in the investment team. And probably the next question I've got here, it kind of probably covers maybe even all four of us, and I think it's one that we got many questions come up, and I think we've just pooled them almost as one question, and it's around inflation. It's a word that comes up a lot in investments in general. So the way the question's been worded, lady and gents, is: with increasing speculation of higher inflation later this year, what can I do to protect my money, and how will inflation affect the market? So I think that will obviously be one that will impact, say, our direct clients, Jamie obviously in giving advice, and George in running the fund. So I don't know, Jamie, do you maybe want to kick that one off, and then maybe over to you, Rebecca, with just how we communicate with our clients and we keep them updated, and then George obviously coming in at the end with another just sort of investment side of things.
Yeah, I think from my point of view, Greg, it's once again, it's making your money work for you. So the idea for us from our sort of investing style, etc., and how we invest people's money is that we want to ensure that your money is beating inflation. So it's not eroding in value, because if it's not beating inflation, you're losing money. I think that's really clear. So I think that needs to be made really clear. So if you've got £100 in the bank today, it might say £100 in a year's time, but it's a lot more expensive to buy. It's more expensive because of inflation to buy products. So you've got to have your money working for you, especially if it's there to save. Having large sums of cash assets, if you don't need it immediately, and it's there for for retirement or for savings in a different way, you need to get that invested and working for you in the right risk profile, or inflation will erode it. And I think that's the key thing. It's always trying to get above that level, to ensure that you're actually beating inflation and getting a little bit more, making your money work for you, or it will decrease. That's the thing. It's really important that people understand that it's just because you've got £100 a day and £100 to next year will be a different value.
Yeah,
if that makes sense.
no, it does make sense, Jamie. And I think, another hashtag coming out there, but maybe do more with your money might be a good one, which our marketing team came up with many, many moons ago to kind of say to clients, you can do more with your money. And Rebecca, do you want to maybe just quickly explain, obviously using the technology and linking that in, how clients can track their performance and see whether indeed they are beating inflation?
Yeah, what I would always encourage clients to do, Greg, is to go into their client sites and set a goal straight away. Set out how much do you want to have saved up, what is it that you're saving for, and what are you hoping to reach this goal by. There's some really great features there on your site which will then give you a projection based on how much you're putting away each month, based on the risk category that you've selected, approximately where we think you're going to be come the time that you want to reach your goal. You can look whether or not there's a shortfall and hopefully do some things to close that gap. But you can also start including in there the impacts of inflation and making sure that actually you're putting away enough now that your growth is going to keep up and that it's going to be worthwhile once we're taking inflation into account. You can look at this as frequently as you like. It updates every single day, and you can see how much your money's worth, how it's trending against your goal, if you're still on track, if maybe you've fallen a little bit behind, or if it's going well, maybe you're a little bit ahead of your goal. But log in, have a look at it. And visibility really is key, making sure that you're monitoring it continuously so that you are on track and knowing that you can take action if you are to fall a little bit behind.
Yeah, absolutely, Rebecca. You're right there. The goal is paramount, isn't it? Every client logging in needs to be comparing against something. And, I look at my goal for my pension and it's, somewhere away, but, it gives me motivation to put money in, to catch that goal up. So, and George, obviously just on the same question really, but how inflation's affecting the market. And if we were to see an increase in inflation later in the year, would we, what would we be looking at that stage?
I think the effect on the market is what we've been seeing within the bond markets of bonds and investors in bonds trying to test central bankers to where they think interest rates should be and when hikes should start to come through. But as I say, central bankers are fairly calm at the moment in terms of what they see around inflation. So I think it comes in terms of the portfolios and how we manage money here. It really comes back to a point which Jamie made, which is around how do you work to beat inflation, and that comes into some of the offsets to the type of instruments which we have there in the portfolio. So if you think about inflation, let's say I'll just take an average. If it was say 2.5%, it provides quite a clear challenge there to lower yielding bonds, so government bonds within a portfolio. So what are the sort of offsets? Well, one, equities. If you think about equities, take a US equity, you could have an annual expected return there of around 8-9%. So that's one of the areas where we can operate within the portfolios to offer a higher yield. Also things like derivatives and alternative products more specifically, and I won't go into the nuances of it, but alternative products are really designed to meet a certain purpose and offer an experience within the market which is very different to what you get in bonds or equities at any one time. So a lot of these products operate to generate a positive return in any market environment. So you can see a better return profile within instruments such as alternatives relative to, say, lower yielding bonds in many examples. So what we're drawing out there is just a few examples of the sort of products which we use within a portfolio to offer clients returns which are outperforming inflation at the defensive all the way up to the aggressive end.
Yeah, thanks, George, and Jamie and Rebecca for the update on that question. It obviously seems to be a very topical piece at the moment. We did have a number of questions coming in on the subject, and probably getting to the end of the questions, but again, one that's probably been in the news and one a lot of people have been talking about. And again, George, I'll probably have you to kick off, but Rebecca and Jamie jump on as well, because I think everyone's got an opinion on Bitcoin or cryptocurrency or whatever the topic word is at the moment. So, I trying to explain to a family member what Bitcoin was, and it gave me a headache. Never mind them. So trying to explain it. If you forget your password, you've lost your money, and it's it is as strange as that. But George, I'll read the question out, and then as I say, everybody, feel free to give their opinion on what is a very almost silly subject in my opinion, but you know, some people do like Bitcoin. So George, Bitcoin's been embraced recently by Elon Musk and Jack Dorsey, so they are the owners of Tesla and Twitter respectively. What implications are there for investors and markets as cryptocurrency seemingly increases in mainstream popularity? I'm not sure how mainstream popularity they've got at the moment, but it is something where sort of seen in the news and seen in, you know, various, you know, investment articles now, George.
Yeah. It's something we treat seriously as a team. You know, it's not something we ignore. Absolutely not. We are, you know, we do look at all assets because it's a personal interest of our own in terms of investing. I think the biggest implication to factor in here, Greg, is volatility, and volatility is the turbulence which you can see within an investment. So for a very high risk investor, if we think about the type of investors who are chasing, say, GameStop as an example, there, that volatility, it's part and parcel of what they're doing. You know, I'm yet to find a friend in one of the group chats which I've got who can explain or justify that volatility to me, but you know, they accept it. What we are building at True Potential is investment solutions to meet investment goals, to meet retirement plans with specific timeframes in mind. So we need to be in a position which allows clients to meet those return requirements, but operate to manage that volatility, that journey along the way. So Bitcoin, you're looking at an annual volatility of around 82%. Now, what does that mean? Well, if we think about assets, and often a risk asset is associated with such a thing as an equity. So if we think about the US equity market, you're looking at an annual volatility there of around 16 to 18%. So 82% for Bitcoin, 16 to 18% for an asset which many investors would consider to be risky within a portfolio. US equities as an example, or gold, you know, typically perceived to be more volatile. You're seeing a volatility there of around 13%. So that's just giving you some context of the sort of volatility which you have within the portfolios. There's also the regulation side of this as well, in terms of holding this within a portfolio. But the difference there is the experience. Peter, one of my colleagues, put on a great article on the blog, which is titled "Coming of Age," which he really outlined a lot of the challenges or the uses of Bitcoin, but the challenges which you face as an investor in there. So Coming of Age, I would encourage everyone to have a look on the blog and have a read of that.
Yeah, thanks, George. And Jamie, Rebecca, is cryptocurrency something you've looked at? Is it something you've ever considered being an owner of a Bitcoin?
Greg?
Not for me, Greg.
Yeah, I think for me, Greg, I would just echo what George says, and the majority of the people that we've got on the podcast and the clients that I speak on a regular basis, it's their life savings. So what we're doing, which is you know, you've got to be very trusted, but we are very trusted in terms of recommending where to put their life savings and make sure it grows for them. So this is pension funds, this is stuff that they've saved up that will be for their ISA and their university fees. And I think, you know, going towards sort of George's point, taking the level of risk, and you look at the volatility within that Bitcoin thing, it's just something you just wouldn't consider putting your life savings in unless you've got millions and millions of pounds, which we know some of these people have. What I don't get, George, is how the owner of Tesla is able to buy Bitcoin and then 2 months later put it on Twitter that he's got it, and all of a sudden it rockets up. That just seems a little bit interesting to me, from a personal point of view. But I must admit, I've always had the theory, if it's too good to be true, it probably is. That's my view on it.
Yeah. Well, Elon's Twitter account in itself, he's been responsible for a lot of, you know, idiosyncratic market moves, which is through GameStop was the key example, which was discussed back in January. So, you know, we were talking a lot. His name came up again there. You know, we were talking a lot about Elon Musk when we were talking about equity volatility. You know, we've had bond market volatility this in February, but I suppose it's back to cryptocurrency for Musk there as well.
Yeah.
Yeah,
control. Yeah, I was going to say.
It's a strange full circle thing almost, because you're right, George. It comes and goes, but cryptocurrency's been around for a while now, hasn't it? And it's kind of, you know, you're right. There was almost that deflection of the GameStop kind of, you know, what went on there. Well, you look at people who invested 10, 20, 30,000 pounds, and 4 hours later they had next to nothing, and that's not the way we'll obviously do things at our end. So I was actually surprised to hear the risk numbers there on the volatility of 80+% versus gold, which, gold, everybody would always say is a risky investment. You wouldn't put all your pension in gold, would you? And that's 13%. So it's just startling numbers, actually. So it's, hopefully that puts everyone's mind at ease that this is maybe just a lot of hype on the internet as opposed to something that's serious for real investors, George.
Greg, when you said at the start of the conversation that you were going to talk about something that was popular this week, I thought we were going to talk about Meghan and Harry. So I had some notes written down there, but obviously Bitcoin's a little bit different.
Well, Jamie, I think that's why I introduced you as Piers Morgan at the start, because I knew
Exactly.
you would bring the royals into it. So there you go. Well, they're not royals anymore, are they? I should call them just Meghan and Harry.
Or Meghan H, whatever.
Mm-hmm. Yeah. No, I was hoping we weren't going to cover that topic, but now you've brought it up, Jamie. I'm assuming you had the popcorn and the big screen on and watched it right the way through as a big Prince Harry fan, as we know.
Yeah, had it on the big screen, had it on the projector, and enjoyed it.
Good. And Jamie, you this morning, I guess we've moved away from the questions and you've turned things into silly season at the end of the session. You told a very good joke this morning. Would you like to share that with George and Rebecca and our thousands of viewers?
I did. I thought it was really funny, actually. We've got a friends group that Greg and I are part of. I basically said, I've invested all of our money in a perfume factory. Our financial advisor warned me not to, but I just think it makes sense.
Jamie.
So, but just to
all
watch.
of our viewers, hit the like button if that made you laugh. If not, this is who we blame.
If we can get some tumbleweed going across the video,
Jamie, I don't think that's going to make the final cut, unfortunately. You gave it a go. We said give it a go. You tried. And it might be time to do your Piers Morgan walk off now, but it's a walk of shame rather than a walk of being angry at a weatherman. So, and how's everybody's weekends looking? I know it's kind of we're nearly there out of lockdown, and I think very soon we can go for a coffee in the park. Is that right? I can't keep up, but we can, I think, meet up with somebody and have a coffee in the park. But has anybody got any exciting plans coming up?
The countdown's on, Greg. The countdown's on till the end of lockdown now. I'm just studying this weekend, so I did another exam last week. Got another few coming up. Trying to get as many in before lockdown ends, and then we're free.
And then you can forget everything you've learned, George. Jamie, any plans for you, mate?
Yeah, I did a couple of exams when lockdown was last year, George, but there's no chance that I'm doing them again. No, I've got it's obviously Mother's Day on Sunday, so obviously we mentioned a few times I had my first little boy in September, so it's my wife's first Mother's Day, so I've been warned. It looks like I'm making breakfast in bed, dinner, presents. I maybe have to get some balloons. These are just instructions I've been given. But no, actually, I'm really excited for it, actually, because it's a pretty special day. So
yeah. I can't work out in the background, Jamie. Are they cans of lager? Is that you ready for Sunday? Is that what that is behind you, or?
That's real crafty ales, Greg. You should know me by now. I'm not a cans of lager drinker. That's me beer subscription. So realistically, I should be putting that £30 a month into an ISA, but instead I put it into beer 56 or whatever the company's called.
Fair enough, Jamie.
You get them regular enough to know the real name, Jamie.
I know. I just drink Becca.
He's pretending he doesn't, he doesn't get a box delivered every day. And Rebecca, you've just bought a new house. I guess you've got loads of stuff to be doing.
Yes, so I am doing the house at the moment has sheets and wet paint and all sorts going on. But we'll be doing all of the kind of boring change your address over with various companies. So you've got all that to look forward to in a few weeks' time as well, haven't you? Yes,
unfortunately, it's one of those, You have to do it, but it's never any fun. But yes, look, ladies, gents, thanks for joining us today. It's been a great session. We've got through all of the questions without tripping ourselves up and giving daft answers. So thank you for taking part, and thank you to all of our listeners for lasting this long on the session. As I said at the start, please do subscribe. It means a lot to us, but also for yourself, you will receive alerts on your phone, on your laptop when we release new content. So when George and the investment team are doing their daily updates or indeed weekly podcasts, you will be reminded to come along to the session and listen. So thank you for joining us. Thank you to George for the investment management insights. Thank you to Rebecca, and thank you to Jamie.
Thanks.
Thanks.
Thanks for watching. If you enjoyed this video, please leave a like and don't forget to subscribe to the True Potential YouTube channel. If you have any questions or requests for future videos, let us know in the comments.